Okay, traders, welcome back to the channel. Here we have a GBPUSD case study, right? So how do you trade CPI? Well, here's a video that can explain to you exactly how to trade CPI, right? So again, nothing really changes, but the market narrative has to be there. And here's what I mean by market narrative. So what I've done is I've marked out the structure. The structure is the first thing we consider as a trader. We identifying basic structural highs and lows. As you can see over here, most recent structure we are currently dealing with, we've seen a break of structure over here. So those who have watched some of my previous videos understand that the 4 pillars are essentially your guide to success when it comes to determining an overall market bias. So those 4 pillars, to quickly go over them again, is that we have our structure or market structure. After that, we have our dealing range. After the dealing range, we have our premium and discount arrays. And last but not least, we have our inefficiencies or our fair value gaps. Okay, so let's quickly apply the 4-pillar formula to the current price action we see on the charts in front of you, right? So GBPUSD daily time frame, I should have said, right? So again, we have a dealing range. We have bullish structure delineated by this break structure to the left of your screen. Our dealing range consists of this swing low up to this swing high over here. Let's remove that low. So dealing range from this swing low up to this swing high over here. Now from here, what have we seen? What have we identified? Well, of course, we have our 50% level, right? So our 50% level represents the equilibrium, and now we see price has come firmly into the discount over here. So we've seen a discounted low over here. So this now is a valid retracement, and it's a discounted low, right? This is a discounted low in the markets, right? What do we mean by that? Simply, it's a correction or a retracement that's come below the equilibrium, thus coming into the discounted region. Hence, we call it a discounted low. And now from here, if we look at the most recent price action, right? What we've seen is we've seen price return once again to the discount over here, in April, but just about 2 months ago now, just under 2 months ago. What do we need to consider, right? We have a fair value gap over here and inefficiency over here. Price here has mitigated the majority of this fair value gap in the discount via this candle over here. So now if we look at the bullish order flow we've had in the last couple of months or so, 6 to 8 weeks, what we need to understand as ICT traders is we need to understand the next DOL, or the draw on liquidity. And what do I mean by the draw on liquidity? Well, the draw on liquidity is essentially where we expect price to target next, and it's essentially a liquidity pool that we expect price to head to next, right? So this is the draw on liquidity. This here is the draw on liquidity. So let's label that DOL. Now, what makes a DOL? What actually validates this draw on liquidity is the fact that we go back to our market structure. Our market structure consists of a swing low down here to the bottom left, and we have a swing up here. Anything in between is all internal structure, right? So when we look at internal structure, the markets will move from internal structure point to internal structure point. Now, for those who've seen the weekly bias is bullish. So that's another indication for taking a buy, via CPI. But the draw on liquidity on the daily time frame is this high over here. And the reason why this is a high is because this high over here tried to push down. In fact, it did push down, but unsuccessfully breaking the previous low, which was down here. And so because of that, the confluence we use to consider this a draw on liquidity is because this is now considered a weak structural high. What do I mean by a weak structural high? A weak high is simply a high that's failed to break the previous low, which again is down here. So this is a weak structure, and it's therefore a targeted structure. So think of strong structures as protected, weak structures as targeted. And simply put, this is a targeted high because there's a liquidity resting above this high. So this is the next draw on liquidity. So if I label that for people, the price I expect, the price that this DOL lies at is 1.289. 1.289. This is the next on liquidity. So I expect price to smash through, eventually up to some higher levels over here where there's inefficiencies. But for now, we're going to be focusing on this DOL, or this liquidity. So now if I bring people down to the 15-minute time frame, right, where this trade was executed, right? What do we see over here? So again, the 15-minute time frame is an interesting one, right? There's a couple of things we want to consider here. The first thing I need to bring to people's attention is this low right here. Now, this is the previous week low. This is the previous week's low, sorry. So this is Monday, the 3rd of June. So if I just drag my arrow across, right, this is a major liquidity pool that's been swept in the market, right? So what makes a major liquidity pool? Well, there's two things, right? There's a couple of regions that are major liquidity, right? Typically, the way that I trade is previous lows, and you've also got previous day lows as well. So these are the two very, very critical areas of liquidity. And once we see sweeps of liquidity of these, often the fair value gaps and the order blocks around these areas are very, very powerful. And this is exactly what we see over here, right? So this trade was essentially based off three things, right? Keeping the edge nice and simple. So this is an edge, or one of the edges and entry models I use that you can potentially employ into the markets, right? So again, what we have over here is we have a major sweep of liquidity. This is the previous week low. So you cannot ignore this when it comes to understanding liquidity, right? So PWL, previous week low, has been swept over here, right? So last week's low was swept. So this is a major liquidity sweep over here. So let's label that in yellow, right? Also, this corresponds with the Judah swing, right? This is the ICT Judah swing for Monday the 10th, right? So Monday the 3rd low was swept by Monday the 10th. And this is a major liquidity sweep in the markets, right? So this is now the ICT Judah swing. Now from here, what we see is we see a clear market structure shift over here. This is a market structure shift, right? MSS, right? So this is one of the things we look for, right? We look for a clear market structure shift. We now want to be buying in an M15, the structural range. So we have some internal structure to deal with, right? So our internal low is down here, and our internal high is all the way up here, right? So our job is to key off a fair value gap in the discount. So this line over here represents the equilibrium, right? This is the equilibrium pricing. Let's label that EQ. Now the EQ is very simple. Anything below the EQ is a discount, and it's the discounted regions that we want to buy from. So from here, if we zoom into price over here, so we've had a major liquidity sweep, right? And now we're looking to buy off a discounted order block. It's really that simple. So we have two inefficiencies over here, right? We have an inefficiency down here, and we have an inefficiency down here. Now, a lot of people ask me, well, yes, I entered off this inefficiency over here, the upper inefficiency, right? Why didn't I enter off here? Well, the answer is you could have set a limit there, but why didn't I? Now, one of the confluence I use is the ICT silver bullet, right? So this fair value gap here is not within the ICT silver bullet region. This is, right? So this is a quick tip, right? This is an ICT silver bullet fair value gap, okay? So if I were to label this fair value gap in terms of Eastern Standard Time, this is essentially 10:15 a.m. 10:15 a.m. Eastern Standard Time. This is an ICT silver bullet fair value gap, right? So just to be safe, I do keep my stop loss below the major Judah swing. So that's a quick tip I recommend to all the intraday time frame traders, right? Have your stop loss in a safe place, right? You don't want to be wicked out and price ends up going in your favor. That's one of the worst feelings as an intraday trader. I'd rather just lose properly and not get wicked out. It's one of the worst things, right? So I personally favor ICT silver bullet fair value gaps, right? So my order block, therefore, was pretty simply this candle over here. And I get a lot of questions about order blocks as well. How do you determine an order block? I recently made an email about this as well to the email list as well. An order block is essentially the last candle of interest before the fair value gap of interest that's been identified, right? So this is an inefficiency over here. This is a time-based fair value gap. So let's label that, right? Time-based fair value gap. And a time-based fair value gap essentially occurs within the ICT silver bullet timings, right? So the silver bullet timings over here are 10 to 11 a.m. Eastern Standard Time. So again, I stress this is Eastern Standard Time. So wherever you are around the world, calibrate your time, to this particular timing of 10 to 11 Eastern Standard Time, a.m. So this now becomes an order block, right? So this is our M15 OB, right? M15 bullish order block, right? And so from here, the trade was essentially entered, all right? This is what makes the order block valid, right? Order block entry over here. Notice how the wicks come in, only the wicks come in. So this is the wicks, you know, this is the overall respecting the fair value gap over here. We see price rejecting off it nicely. And so again, my entry was at the vicinity of the order block. Again, I recommend having my stop loss slightly below the Judah swing, just at the Judah swing or slightly below the Judah swing. Again, you want to be safe, you want to be in the trade. I'd rather just be in the trade and let the risk reward just take care of itself. And of course, the risk reward on this trade was fantastic, right? So another question I often get is, where do you target on this trade? Now, I personally exited 90% of my volume at a 1 to 2. And the reason for that is because I personally like to be risk-free before crazy news events like the CPI. But the question now is, where do you target? Well, last week we had inefficiencies from NFP. We had a massive inefficiency over here. So those who do a lot of data gathering, back testing, and just generally understand how the Forex markets work, a lot of the time the NFP fair value gap is often just not respected, right? So it's almost like a smart money trap. You don't want to be selling off the NFP fair value gap. So what we have is we have a very, very large NFP fair value gap over here, right? So the overall narrative of this trade was to hold it to, I believe it was a 1 to 2.5 or 1 to 3 hour trade, right? Yep, just over a 1 to 3 hour trade, right? Targeting the inefficiency, right? This is essentially how the markets work, right? So the markets operate of something called the interbank price delivery algorithm, and we've literally gone over the interbank price delivery algorithm without even mentioning it in this case study, right? So the IPTA itself goes over, or is based upon 3 things, right? It's based upon liquidity. The markets want to target liquidity, the markets want to target fair value gaps that have not been filled, and the market moves from a discount to a premium, or from a premium back down to a discount if this was a bearish case study, right? So from here, we're going from a discount. We're going from a discounted range. Again, this is a discounted order block up to a premium, and we're filling in inefficiency. So the overall market grab in the intraday DOL was essentially simply just to target this liquidity over here, right? So the market targets liquidity and fair value gaps. It moves from a discount to a premium. These are all the basic concepts that you can take into your trading. Now, the secret is to make it unique to you. But as long as you can take these basic concepts which work, that's literally the underpinnings of how the market books and works in the first place. If you can use these concepts to your advantage and make it unique for you, that's literally all you need, right? So you don't need to overcomplicate price action or SMC or ICT. You can keep it very simple using the case studies I provide on this channel.